Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, August 12th already. Just after the close, I'm with Patty Healy, Senior Vice President, Head of our Credit Research Department. Patty's going to talk a little bit about what she saw in fixed income this week. Over on the equity side, I don't have an awful lot to talk about. The market did the talking for us. In terms of what I'd like to focus on is something that perhaps doesn't get discussed enough, and we try to discuss it quite a bit on these videos, and that is behavior. Behavior in the markets is often overlooked, but it's the bedrock of where people are positioned in the market. So you'll have fundamental people look at a 8.5 inflation reading and say, how can the market go higher? That's a huge number. It was 8.5 in March and everybody went nuts and the market sold off. The positioning was different in March. The outlook was different. After we got through some of those horrendous June days where we saw speculative selling and positioning in the options market, betting on declines to the same level of October 2008 and March of 2020, COVID March, that took out an awful lot of the sellers, and you got people leaning the wrong way. So now you don't need great news, you just need not so bad news. And that's what we've seen. So the only thing not working this week and last week was cash. And you know, we have some cash in our equity strategies. That's okay. Market trades next week. Market trades the week after that. Trades next month. We'll get that cash in at reasonable levels. We had nice moves across the board in equities. It was interesting to see. We almost fell back to that 2004 through 2006 theme this week in equities. That was back when the Fed raised rates, 15 meetings in a row? Something like that. And what worked? Basic materials, commodities, small caps, small cap value, nice rips in those areas. So we don't have to just think about S&P and NASDAQ. It's a nice broad market. And in terms of fixed income, we stayed within a range. What did you see primarily?
Well, with the big CPI number and inflation being lower than people anticipated and at month over month at zero, people started to maybe change their thoughts and outlooks or maybe their behaviors. Like you mentioned, some Fed governors were saying we're going to keep on, the inflation trend, and some people are saying maybe we won't raise as much. There's been slowdowns in jobless claims increased a little bit. And we're seeing, home sale prices going down. So there's mixed messages, but so we'll kind of see what happens with the Fed being data dependent. So we have to keep looking at the numbers and people's behavior. The 10-year ended at about a 285 this afternoon, but the 2-year is still at about 320 something. So it's still it's a
fairly steep inversion, right? And you hear that all the time. An inverted yield curve, and it's a oddity when a shorter maturity is offering more in yield than a longer maturity.
Right, it means banks aren't really going to be making money lending long and borrowing short.
Right, and often we say that it's not that the curve is inverted, but it's how long it stays inverted can be a problem both on the equity side and perhaps on the fixed income side. I know Moose is fond of saying recessions are caused by inverted yield curves.
Not that they're a signal of inverted.
Right.
Of recession. Right.
Right.
Also on the muni side, it was like a sleepy week this week, kind of things for demand in the munis. So next week with more news, and it may still be the summer doldrums, but we also have a large amount of supply coming, like 11 billion. And we had outflows last week, which was unusual because the prior 2 weeks we had inflows into mutual funds. So if we've got some outflows and we have larger supply, that means yields would go a little bit higher, generally speaking, to entice people to come into the market. This week ended up at a muni Treasury ratio, so that's the yield on a muni bond compared with the yield of a Treasury bond. For the 10-year was at 79%, and for the 30-year it was like 94%, close to 100. So wait, what are we talking about here? You can get a muni bond yield close to a Treasury bond yield, and you don't have to pay taxes on the income that you're getting on the muni income. So, and credit quality for munis is expected to continue strong for a while because of all the windfalls of revenues from various sources, and we've talked about that in the past. So we're very constructive on the muni market.
Good, good.
Yeah.
So in terms of what we'll be looking at next week, if there's a hint of caution in the market, what I would say is we're seeing a little bit of the flip side of that speculative put buying in June. Starting to see some speculative call buying. So premiums in calls jumping. Remember, back in June, we hit record premiums in puts. When I say record premiums, people were paying up to 30% more in terms of premium versus what it had been just 2 or 3 months earlier. We're starting to see some real speculative action in calls. So we're also seeing some of those meme stocks run. So we have to be a little careful about speculative juices running a little ahead of ourselves. So we'll see what next week brings. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. And everybody have a great weekend.
See you next time.